Hello, and welcome to the first of a new series of videos that will look back at the Stage 2 advances of some of the leading stocks over the years. Studying historical charts of leading stocks is a great way of learning the characteristics to look out for, so you can get into the next big winner at the right time and then hold it through the bulk of its Stage 2 advance, and then get out before you give back a large portion of those gains as it tops and moves into a Stage 4 decline. To learn more about the stage analysis method that I use in these videos, check out my new course on Udemy.com called Learn Stock Trading and Investing Techniques Stage Analysis. There's a 30-minute free preview, and I've included a link to the course in the description below, or you can find it by searching for stage analysis on Udemy.com. Back to today's video. The first stock that I'm going to analyse is Adobe's 2-year Stage 2 advance from its initial Stage 2 continuation breakout in late 2012. Where it advanced over 100% before triggering a stage analysis investor method stop loss. Let's begin by looking at the weekly chart from December 2012. So let's start by looking at the characteristics that we look out for in stage analysis. So we're looking for, on a stage 2A breakout, we're looking for the 30-week moving average to start moving up. We're looking for the price action to be above a rising 10-week moving average. We want volume to be over 2 times the weekly average on the breakout, and we want to have strong relative strength versus the S&P 500, ideally breaking out to new highs and above what is known as the zero line, which is the Mansfield relative strength, which is basically the 52-week moving average of the relative strength of the stock versus the S&P 500, so which is this blue line here. So it's the 52-week moving average of the stock divided by the S&P 500, and the relative strength line here obviously oscillates above and below that depending on what stage of the market we're in. So we're looking for this to start curling up as the relative strength line itself starts to move to new highs. So as you can see in Adobe's case, it obviously was breaking out, the RS was breaking out to new highs. We were getting a little volume pop of just over 2 times the average weekly volume as it broke out, but it had come out of a choppy sideways range for the last few years before that. So another thing that we look for is for how the stock compares to how its relative, we're looking at how its relative strength compares to the S&P 500, but we obviously need to compare against the market itself. So if we look back at the S&P 500 from late 2012, you can see that the market itself was in an uptrend. So we call this a stage 2 advance. So it was just potentially showing signs of stage 3, but with a bit of a choppy stage 2 advance, as it had pulled back below its 30-week moving average, but it got back above the 10-week moving average again. But it was looking a little bit tentative here. But the Adobe was breaking out at the time, and it was still in a stage 2 advance at the time. So this is one of the characteristics that we look out for. Ideally, you want the stock and the market to be in sync. So basically, as long as the market's in either stages 1 or stage 2, then it's generally good to go. And so in Adobe's case here, you can see it went through a whole range of stages throughout 2010, 2011 and 2012 here. So its stage 4 decline here coincided with the market decline, as you can see here. So the S&P 500 in 2011 obviously put in a large stage 3 top here. We got a big head and shoulders top before breaking down with a rapid crash in August in 2011 there. So Adobe before that was underperforming the S&P 500. As you can see, its relative strength was trending below the market. But as we started to move into 2011, and as the market was just starting to top out and move into a stage 3 top, Adobe did start to show signs of basing and moving into an early stage 2. However, the volume was very weak and the relative strength was still weak and had not yet broken above the relative strength line, and the relative strength line, the zero line that I mentioned, was still declining. So this breakout, as it was moving into resistance from the previous decline, failed, and it moved back down into a stage 4 declining phase once more and made a new low before starting to form another stage 1 base at the end of 2011 at the same time as the market. So as you can see, the stock then got back in sync with the market. So as the S&P 500 based, the stock started to base, and we started to get similar sort of pattern, and we started to see Adobe start to outperform, as you can see from the relative strength line, and it moved above the 0 line as it made a early stage 2 breakout here in the start of 2012. However, the breakout wasn't on any kind of significant volume, and it was in a zone of resistance from the previous breakout here. So one thing we look for in the method is for it to have no near-term resistance and strong volume on the breakout, as well as the other characteristics of strong relative strength and the 30-week moving average rising and the 10-week moving average rising, etc. So the fact that it's still got this heavy resistance here, and we've got a stage 4 decline coming from the top left of the chart there, so this breakout was still considered too early. So, and as you can see, it then rolled over and pulled back before starting to consolidate in mid-2012 while the market was still going higher. But the pullback again coincided with the market pullback, so you can see that the stock had got back in sync with what the market was doing, and it was still outperforming, although it was starting to trend and get more in line with what the market was doing. But as you can see, the 0 line started to flatten out and curl upwards as we got nearer to the end, and the volatility in Adobe started to contract around the 30-week moving average and the 10-week moving average, and it started to get much tighter. And then we finally got the stage 2 continuation breakout at the end of 2012 here, with this 2 times volume coming in. So let's have a look at what this looks like on a monthly chart at the same time. So on a monthly standpoint, you can see that it was making an inverse head and shoulders pattern over a 3-year period. So this was a massive basing pattern that it was making. And note how the right shoulder low is higher than the left shoulder. So this is something you want to see in this kind of pattern. So when you get an inverse head and shoulders pattern, you want to see this right shoulder, you want this to be tight around the 30-week moving average and much higher than the left shoulder, because it shows that the volatility is contracting and that the line of least resistance is getting weaker, and then the stock is ready to move. And as you can see, the volume as the base develops is gradually getting lower and lower. So you can see there's a lot of distribution volume as it's going down here, but it's gradually grinding lower. And as it breaks out, the volume was near the lows, so you've got a nice volatility contraction with if you go back to the weekly, you can see you've got the inverse head and shoulders pattern, but within that you can see there's a kind of cup and handle pattern as well. So this is a bit of a volatility contraction pattern with a cup and handle. So if you look at the daily chart, the trigger for the stage 2 breakout looked to be an earnings gap. You got a gap up here on heavy volume, and this heavy volume shows institutional buyers coming in, because there was 17 million shares on the day. So that's not your average Joe coming into the market. That's institutions getting in heavy, and as you can see, the relative strength line burst out to new highs at the time. So this is what we look for when we're getting in. This is what's stage 2 continuation breakout. So now let's look at the stock and how it did as it went through its stage 2 advance. So this is the same point here as we've got up on the left chart here. So that's the stage 2 continuation breakout, and that's the same bit here. So this is the right shoulder, and this is the right shoulder. So you can see the gap breakout, we didn't get any significant pullback from that gap. It literally started to trend higher immediately through 2013 and went up for multiple months before its initial pullback. So it made a 31% advance before pulling back, before it made it first pull back below the 10-week moving average here of 11%, before making a little cup pattern again and making a new breakout. So at this point in the method, with this new breakout, we would raise our investor method stop loss up below the swing low and the 30-week moving average, so the stop loss would move up to around this level, and then as it swung up again and broke out further, so the investor stop loss again would get moved up and would be below the 30-week moving average and below here. So it then had made a few bases on the way up, and the investor method stop loss would have continued rising, but the pullbacks weren't too big on Adobe. It was only 8%, 7%, before we finally got this character change. As you can see, we were 3 or 4 bases in, and then on this base we got a significant change in character. So as the stock progresses in stage 2, you tend to get the risk tends to increase of failure. So you generally only get 3 or 4 bases before we start to see a new significant consolidation phase, which could form a stage 3 top and collapse into a stage 4, or could make a further continuation higher, but it normally needs to make a rest after a certain period of time. And so character changes is what we're looking out for. And so after almost 100% move here, we got a significant pullback of 20%, which pulled back to the 30-week moving average here, and then failed to get back above a declining 10-week moving average, and pulled back further, and actually pulled back to the test the low from the previous swing low. So as you can see, with the investor stop loss, the stop loss would have moved up below the 30-week moving average here, and the swing low, so it would still be down here. So the investor stop loss would have kept you in, as that it didn't touch that, and then we moved up again before it made its ultimate high here at 108%. At this point, because we'd seen a character change, they would have started to get more aggressive with the stop loss. So the investor stop loss gets changed to a more trader method stop loss, and you would have started to push higher and possibly below any kind of swing low that formed above the 10-week moving average. So you may have got out up here with a 10% pullback, or you could have waited, you might have kept it below the 30-week moving average, which was still rising, and got out ultimately up here, which would have still secured a 80% or so gain. But you can see there's a pattern failure going on here. So we've got like a bit of a cup with handle type pattern. So we've got a bit of a, but it's a high handle, so it's a base on base type pattern. So cup and handle with a sort of flat base type pattern there. And then that broke down. So at this point here, you can see the heavy volume started to come in. We've got some divergence coming in as well with the relative strength line. So you can see throughout the stage 2 advance, the relative strength line trends higher throughout and stays above the rising zero line here, which is the 52-week moving average of the relative strength, remember. So, but you can see here, as the price action makes a new high, the relative strength line did not. And again, we've got a lower high here, and the relative strength starts to tail off and starts to move below the zero line, and then is breaking down here. So whether you were triggered out for the investor stop loss here or not, you would have, with the breakdown in relative strength, would have also been a signal, as well as the heavy volume 4 weeks beforehand on this initial breakdown here below the 30-week moving average, as that again would be a character change, as until that point the majority of the heavy volume had been on up moves, not on down moves. So this is the kind of stuff that we look out for, and this is how the stage analysis method would have helped you get 100% gain in Adobe. Okay, that's the end of this video. Thanks for watching. To learn more about the stage analysis method, you can, as I said earlier, you can take the Udemy course with the link, and you can see the link below, or you can follow me on Twitter at Stage Analysis, or come to stageanalysis.net, where you can learn more about the method and join the forum. So thanks for watching, and I'll see you on the next one.